Hello and welcome to marketing91.com. Sales performance, meaning sales is a central factor or parameter in an organization's performance. Sales performance at the organizational level must be evaluated from different perspectives to identify drawbacks or shortfalls in the sales strategy. Supervision and control of sales force. A sales force can be effectively managed only through proper supervision and control. Salespeople may have good caliber, training and motivation. Nonetheless, they require necessary direction, supervision and control for optimum performance. Purpose of supervision and control. Supervision and control of the sales force are required for the four main reasons: coordinating sales efforts, guiding the sales force, improving selling efficiency, and evaluating performance. Methods of supervision and control. Methods for supervising and controlling sales force include allocation of sales territories and fixing sales quotas. More direct methods of control include reports and records. Salespeople must submit written reports on various aspects of their activities in prescribed formats. 10 important reports are as follows: daily calls by salespeople, tour routes and plans, customer complaints, reasons for missing customer calls, prospective customers, market conditions, position of major competitors, prices of competitive products, effectiveness of sales promotion activities, and salesperson's expense account. Direct supervisory methods. Telecommunications. Sales managers can use telephone, email, voicemail, fax messages, and computer-based support systems. Sales meetings. Sales managers use sales meeting to provide information about changes in policies and procedures, arranging for training programs, and inspire or motivate salespeople to achieve sales quotas. Personal contacts. Sales managers may visit customers with a salesperson for reasons such as calling on a specific customer to handle a particular problem, training a salesperson, team selling efforts, and obtaining market information. And lastly, coaching. Sales managers must concentrate on the continuous development of a salesperson through supervisory feedback and role modeling. Coaching involves intensively training a salesperson on the job through instruction, demonstration, and practice. Indirect supervisory methods. Sales reports. A salesperson's activities can be monitored and evaluated using a supervisory tool such as a sales report. Customer and competitor data included in the sales reports is used for the company's marketing information system. Compensation plans. Compensation is one of the most important tools that encourages salespeople to carry out activities that will maximize their income or commissions. Sales analysis. By using a sales analysis report, a sales manager can evaluate each salesperson's performance by comparing what was sold and how much was sold with the sales quotas. Expense accounts and reports. Expense reports indicate how much money a salesperson spends on traveling, lodging, meals, and entertainment relative to company policies on various expenses. This helps to control selling expenses. Sales performance evaluation criteria. For evaluation, it is essential to determine the right mix of performance criteria. These criteria should focus on results and identify key result areas, or KRAs. KRAs are factors or aspects of a sales plan, strategy, and implementation in which a salesperson or a company must excel to outperform competitors. 12 important KRAs are given below. Sales approaches to appointments, appointments to inquiries and proposals, inquiries and proposals to sales, orders to sales calls or strike rate, sales revenue per order, sales per hour of selling time, sales to cost of sales, gross profit or margin to sales, call rate per account, new accounts to existing accounts, rate of business development, new customers to new prospects, actualization rate, and sales to market potential. Profitability criteria. Salesperson profit and loss account. This measure of profitability expresses the total gross margin generated by a salesperson as a ratio of his or her total sales during a particular period. A more focused or direct measure of a salesperson's profitability is his or her profit or loss account for each major customer or product handled. Many salespeople realize that they incur costs and their efforts should result in some benefits. Combination of quantitative and qualitative criteria. KRAs or quantitative indicators help to arrive at quantifiable results. Simultaneously, qualitative evaluations, though not strictly measurable, are also important. In fact, quantitative and qualitative criteria are often interrelated. For example, a low or poor orders to sales call ratio is a quantitative evaluation measure. However, to understand or analyze this poor ratio, qualitative measures such as the salesperson's product knowledge, selling skill, and customer relationships must be evaluated. 12 major qualitative criteria categorized under 4 heads are mentioned below. Personal characteristics, attitude, initiative, creativity and innovativeness, and aggressiveness. Knowledge, product knowledge, market knowledge, and knowledge of company policy and strategy. Skill, which includes selling skill and communication skill, and self-management, planning ability, judgment and decision-making ability, time management. By using these criteria, a qualitative assessment or evaluation is performed using a 5-point rating scale such as 5, 4, 3, 2, 1 or excellent, very good, good, average, and poor. Sales performance review. A company's sales performance can be comparatively assessed in 4 different ways with different bases of comparison. Actual sales or total in relation to target. Sales growth or decline relative to last year. Sales growth or decline in comparison to industry growth decline. Sales level compared to that of major competitors. Sales management audit. A sales management audit is a systematic, diagnostic, and prescriptive tool for analyzing, reviewing, and controlling sales operations or the sales management process. In financial or accounting audits, all financial transactions are checked in terms of company policy or approvals. On the other hand, a management or sales management audit aims to assess whether a firm's sales management process is adequate to give direction for performance improvement and to recommend the needs changed. Stay tuned for more videos on marketing. Thank you.